Welcome to the Bogart Effect, a wealthy wisdom podcast. The following Bogart Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning, everyone. This is James Bogart, CEO and President of Bogart Wealth. Thank you for joining us on the Bogart Effect. Today with me, I've got Daniel Evans, and we're going to talk a little bit about investor behaviors. Thanks, Daniel.
Yeah, absolutely. Thanks, James. I think today's landscape of the investment world, I would argue that it has changed dramatically. And ultimately, a lot of that comes to the access and the speed at which we exchange information and it impacts our investment decisions because it evokes our emotions. Today I want to define, a few of those emotions so that we're aware of it and, ultimately lead us down the path of making sound, financial investment decisions.
I'm a big believer that an educated investor is an empowered investor, but at the same time too, probably arguably the number one detractor from someone's accumulation of wealth is their emotions. And I think a lot of what financial advisors have to do is be psychologists, understand what our clients are going through at any particular point in time. And I'll tell you, in the background for Bogart Wealth, we're big advocates for having financial plans because it gives us the baseline to be able to operate off of. And hopefully, as we can structure the portfolio for a customer, they're able to have a better framework to remove that emotional reaction from the investment process itself. So, with all of that said, why don't we start at a high level, Daniel, of kind of some of the different things that we're going to talk about today, and then let's drill down into each of them respectively.
Yeah, from a high level, we're dealing with fear and greed, ultimately, you're exactly right. The financial plan, all the conversations in this discussion will lead us to the need for a financial plan in order to stay objective. I'm an advisor and we do this, professionally for a living. It is hard to control those emotions, so that we're susceptible to it. But I also know that we rely on the financial plan and, our investment team to make those decisions instead of, what we might see on, the news on a day in and day out basis. But we have these behaviors that impact, why we buy or why we sell or why we make different decisions, from, like I said, fear and greed are too big from a high level, but we're also going to we're going to put some definitions behind a couple of them called herding, loss aversion, and anchoring, and we're going to touch on a few more.
Yeah. So when you talk about, for example, herding, what is that? It's not obviously wrangling cattle or anything like that.
You could define it as the fear of missing out. We can also, look at it as following, the actions of others without making, the decisions on our own and what's best for our circumstance or our scenario. And ultimately, we find that, going against that is kind of against our nature, and it's relatively painful. I think we're kind of hardwired as humans for a herding mentality. But we just have to be aware of it when it comes to investment decisions.
Well, and truthfully, we're seeing it probably more than ever right now, given the market environment that we've had for the last, let's just say, 15 months. Right. The S&P 500, it's a market cap weighted index. You've got 7 companies that are all tech companies that are driving north of 75% of that return. And yes, if you were in all tech, you had a fantastic 2023 and you've had a fantastic 2024 thus far. But the reality of it is most investors are not investing for a 12, 15, or 18-month period of time. More often than not, they're investing for significantly longer than that. At least that's the hope, right?
Right. And a lot of these behaviors tie into each other, and we'll address that here a little bit later. But also, we talk about the, Magnificent Seven, and one thing that's not, mentioned a lot. I mean, there is a risk level that is associated with those stocks and that type of strategy that may not be suitable for other clientele. And so having that diversified approach, having the plan, having the objective avoids that. But I mean, absolutely, when you're looking at your portfolio and you see a 14-15% year, which by the way, I mean, historically is fantastic, but you look at the S&P 500 and it's 27, 28, 29%. I mean, it's kind of hard to look at, but over the long run, I mean, that's a 100% good rate of return.
So let's talk a little bit about loss aversion.
Yep.
What is it?
Loss aversion is our bias towards avoiding a loss. And I don't want to say at all costs, but being more conservative. Think of going to cash. If the market gets volatile, we want to sell out of it and go to cash because, we're not, comfortable with the swings in the market. I mean, which ultimately can really impact the portfolio and, the probability of success over longer periods of time when we're out of the market.
Well, and I could tell you empirically, like we had some clients that were so adamant on going to cash in 2020, as an example. I mean, and you want to talk about an environment where we were dealing with financial well-being, physical well-being with the pandemic. And the reality of it is of the 7 clients, we had about 600 at the time, but of the 7 clients that went to cash, not a single one of them had anywhere near the level of return that the rest of the customer base did, simply because they weren't invested. And we can talk about this at length, but it's one of those where if you're not invested for the 30 best days of the year versus the 10 best days of the year versus the 5 best days of the year, and how different that changes your results. I mean, that's exactly why we're not necessarily in the camp of you need to constantly be invested. We're more in the camp of we need your portfolio aligned with your appropriate level of risk, with the direct intent associated of wanting to reduce emotional reaction. And so, that's where, and I'm a big believer, no matter what phase of life you're in, you need to have your short-term bucket, your intermediate-term bucket, and your long-term bucket. And dependent upon your needs, your situation, for example, you're still working and you're in the accumulation phase and you don't need the money within whatever the respective time frame is, 3 years, 5 years, 10 years, that money should absolutely be invested more towards capital appreciation and growth. If you're more in a retirement mode where you need income, you need cash flows, well, yeah, we need to have those buffers built in place so that when the market does have its period of time with volatility, which by the way is very normal for the markets to have double-digit volatility intra-year every single year, that's normal, right? That we don't react adversely that has a material impact on the future of a portfolio. And this is why I think coming back to having a plan so that you can, as comfortably as possible, predict when these outflows are going to come up, whether it's buying a car, buying a house, college for the kids, whatever it is, that we know when it is so that we're not having to adjust a portfolio or investment allocation on the fly dependent upon those cash needs.
Yeah. I mean, I think some of the underlying tone behind that is time horizon and the longevity of retirement. I mean, and this isn't just for retirement, but this is for our lives. I mean, for when we save, for when we, whether it's college education, whether it's retirement, kiddos, I mean, all aspects of life. I mean, this is 30, 40 years. So when you start looking at it from a going to cash perspective, I mean, you start looking at average yields over the last, 20, 25 years. I mean, outside of last year, I mean, we were sub, 2% for most of that time period. I mean, during that time, the S&P 500 was roughly, average 8.5% rate of return. So purchasing power comes into effect there, and I believe we've seen felt the effects of that, here over the last year or two. But 100%, again, the objectiveness, the financial plan, and the time horizon in which we're looking to achieve.
So let's talk a little bit about anchoring. What is that?
So anchoring is, putting too much emphasis on one piece of information when making a decision. I've had it explained to me like this, that, price point is on a personal note. We tend to, or the example I want to use is, if you think about buying a car and you find a car and let's say it's $40,000, but you want to do your due diligence and you find a similar car at another dealership and it's $50,000. Well, an example of anchoring is being biased towards that $40,000 at a lower price point, and it really pulls our decision making in that direction, without looking at resale value, safety ratings, fuel economy, and other important factors that impact that decision. And then, when you look at it from a investment standpoint, when you set market expectations or return expectations, right? I mean, again, time horizon and the longevity of what we're planning for. I mean, the average market return over the last 10, 15 years of the S&P 500 is darn near, 17% over the last 5 years, 15% over the last, 10. But when you start looking at it historically, where that number is more around 8.5 or longer periods of time, it lowers. So when we set our expectations going forward, it's most recent. What we see is the higher returns that we've seen recently.
Yeah, no, and I think, again, related to your point, talk about time horizon, but it's alignment of your comfort level with risk. Personally, I think investors have very short-term time horizons, and it's very easy to forget that in 2022, the S&P was down 18.7%. And for a lot of investors, that caused them to change their investment strategies, whether it be intra-year or towards the end of the year, which, frankly, we've talked about this many times, but a lot of times when things are down, that's when you really want to be looking a little bit more opportunistically. Looking at those tech companies at the end of 2022, we saw how well that performed going into 2023. Some of those very difficult and hard decisions have to be made when the markets are at their most volatile points in time. So Let's talk a little bit about present bias. What is that?
So this is a big one, and I think that this is involved or is impacted our daily lives, personal lives, culture, society. I mean, whatever blanket you want to cast on it. I mean, ultimately, we're looking at immediate rewards, versus or at the expense of longer term, goals or longer term funding. And, it's a little bit of an easy one to pick on, but it's absolutely spot on. I mean, you can look every, financial publication, bank industry that you want to look at the study. But the fact is that over the different age groups that we have a big, retirement shortfall amongst all the different age groups. And I think that is a direct correlation and an impact of, spending now versus, saving and planning for something longer term in the future.
Well, and here's some really scary statistics. There's 336 million Americans. Right. 4.8 million have more than $1 million of investable assets. 1.8 million have more than 5 million of investable assets. I mean, so dependent upon what someone's priorities are, well, I would argue that most of America is not adequately prepared for even the conversation around retirement. And this comes back to this alignment associated with goals. What are your goals? Because the more you save, the more you have. I mean, we jokingly will say that from a financial advisor's perspective, work till you're 80, you die at 81, the plan's going to work great. If you save every dollar you make and leave nothing left to live, your plan's going to work great. But, from my perspective, I think it's a very basic math equation. And I'll talk about this time and time again, but it's what someone spends versus what someone has is what ultimately determines long-term success. And That's what I believe will be the key to just anyone's financial plan. And then from there, we're able to build it out and optimize. But any investor that comes into a year thinking that they need to have 7, 8, 9, 10% annualized rates of return in order to be able to make their financial plan work, well, I'm going to argue that you're not adequately prepared for retirement. There's not enough money there. That's not a realistic expectation. And frankly, you're taking on too much risk in order to be able to make that plan work. On the flip side, if someone is drawing, let's just say 4% of their assets, using a 5.5% rate of return with a 2.5% for inflation, so 3% real rate of return, they're able to see their portfolio survive for 41 years. By the way, a 3% withdrawal rate means that their portfolio will last for 99 years. And on the flip side of that, a 5% draw rate means their portfolio is going to last for 27 years. So if you're a 60-year-old and you're drawing at a 5% withdrawal rate, yeah, you're probably going to be okay, but it's getting a little tight, right? So, and that's where I think it's important to talk about what are we drawing versus the level of assets that we have, fully recognizing we're going to have good years, we're going to have bad years. And that's why building out those cash flow strategies are going to be so critically important with this. So let's talk a little bit about availability bias. What is that?
So availability bias, I mean, we can look at this as many different ways that we can look at it. I actually used to work in advertising before I became a financial advisor. And availability bias is almost essential in the reasoning behind why you're marketed to. Ultimately, it's making decisions based off of what's most relevant, what's most recent, or if there's a traumatic event. Matter of fact, before we scheduled this, I was kind of brushing up on availability bias, and I came across a study. And this one kind of blow you away a little bit, but it was the question was asked: what scenario is more likely to cause death? Parts falling from an airplane or being killed by a shark, and this is in the U.S. And the overwhelming majority of it was answered by being killed by a shark. But the reality of it is that the probability is 30 times more greater of being hit by falling airplane parts. But we don't see that. We don't see news on that. But a shark attack, we see that on the nightly national news. So it's available to us. It creates a traumatic event, and that's what we're being fed. So it draws our bias to believe that event happens more often when, the perception or the facts of it is the opposite of it.
Oh gosh. So, there's so many applications to that same comment from a market perspective. And frankly, I'll tie it back to the comment you made at the very beginning is the availability of the information that we're being fed. 30 years ago, we didn't have immediate access to information the way that we do now. Frankly, look at 60 or even 90 years ago, how things have changed. And now with the dependency on social media, the availability of everything on a screen that's in your pocket, day in and day out, or even the ability to make changes in your portfolio because you have such immediate access to not only the information, but even the ability to make the change on your mobile device, right? Like that to me is I'd say scary, but it's also one where it's just not sustainable long-term either, right? And comes back to emotions and the ability to build out a long-term plan that is going to help keep those emotions in check. I think it's important also to remember the media sells fear. It's clickbait, right? They need to be able to sensationalize everything that has risk in order to be able to turn it into advertising dollars. And that's where, staying anchored, staying, fundamentally routed into what the long-term plan is, I think is at the epicenter of even this discussion.
Yeah. 100%. Remember even Wall Street itself is selling something, right?
Of course.
Even when you turn on the news, you look at it, ultimately that's views. Which what you mentioned is advertising dollars that come back to it. But to translate it another way into the investment world, Franklin Templeton did a survey. And they conducted a survey on the perception of the market returns after 2008. So this in 2009. I mean, 2008 was very impactful, traumatic. We heard about in the news a lot of impacts. A lot of individuals and families really, really were hurt by that. But the question was posed is what was the returns of the S&P 500 in 2009? I mean, I think it was two-thirds. It was two-thirds of the answers was that it was flat or negative. But in reality, it was up almost 27%. So we have it. It shapes a perception, but again, we're not based on fact, which doing full circle, leads us right down towards the importance of having that financial plan in place.
Well, and what about statistical biasing, right?
Yeah.
I mean, at any point in time, you can find the data that you want in order to corroborate or support the argument that you're trying to make. And I'm going to come back to the availability of information. That might not necessarily be fundamentally correct. And like, for example, look at NVIDIA stock. It's hard to argue the performance of NVIDIA stock. And I do think and believe that AI is going to be at the forefront of a lot of the discussions we're going to be having for years and years and years to come. And that is a company that has been really, I'd say, at the forefront of that development enhancement. But the reality of it is that that's one company, which means you carry with it the risk of being invested in one company. And again, it's a tech company, right? At the root core of what it is, it's a tech company. I'm not saying it's not a good company, by the way, but recognizing you need to understand risk. It's one of the stocks you have to address when you talk about any one of these emotional biases. This is a great conversation. Anything else we want to talk about today?
No, I mean, ultimately, being aware of these behaviors, right, is now we can learn from them and we can help steer. I mean, as advisors for individuals, for families, but ultimately being aware of them, we can check ourselves and making sure that we are making, rational investment decisions that are, in our best interest with our financial plan and our goals that we want to achieve.
So the moral of the story is don't let emotions take over.
You got it.
Hey, thanks for the time today, Daniel. I appreciate it. Look forward to having you back.
Yeah, awesome. Appreciate it. Thanks, James.
Thank you. The previous podcast was intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Different types of investments involve varying degrees of risk, and it should not be assumed that the future performance of any specific investment, strategy, or service will be profitable, suitable, or successful. Bogart is not a law firm or accounting firm, and no portion of its services should be construed as legal or accounting advice. There is no guarantee a client will experience a certain level of results if Bogart is engaged. Our brochure describing services and fees can be found at www.bogartwealth.com.